Well, let's get to our market master of the day, Shridatta Bhandwaldar, who is the head equities at Canara Robeco Mutual Fund, joins us now. Shridatta, thanks a lot for joining in on the show. Appreciate your thoughts. How are you feeling about the market now? Is this a time when one should be looking to take some profits off the table, or just ride this wave because perhaps there's lots more to go on the upside?
Good morning, Sonia. Thanks for having us on the show. No, clearly. So while the market, like you rightly alluded, there has been a little bit of fronting in terms of returns. There has been a little bit of extra enthusiasm in market for last 2 or 3 months. But it is not without reason this time around. And that's where we are not actually, while in near term, as I said, I mean, there is a little bit of enthusiasm. We are not, we continue to be constructive on market. And if I have to actually take you through why do we think that basically one should remain constructive, not necessarily from next 2 months, 3 months perspective, or from next 2 or 3 years perspective. You have to step back and think in terms of what are the reasons why market actually consolidated for 18 reasons for first of all 18 months for first of all market actually consolidated for 18 months for a very simple reason that for financial year 23 you experienced earnings downgrades of 6 to 8%, and at the same time you had cost of capital moving against you. Both those key aspects which were actually working against market actually started turning more constructive. I'm not saying they're absolutely positive, but at least they have started constructing far more positive. If you look at fourth quarterly results, this was the first quarter after almost 4 or 5 quarters where you saw upgrade downgrade ratio improving. So earnings clearly are looking like far more resilient. One. Second, your cost of capital equation globally and domestically, we have probably seen the worst of the interest rate cycles. While there will be 1 or 2 incremental interest rate hikes, it's more backward-looking data. Incrementally, the inflation data is telling you that your cost of capital equation has started turning in your favor. So when you look at both those factors, as they have started turning constructive, market has actually reacted to that after a consolidation of almost 15 months. Having said that, when we look at it incrementally from here on, again, the earnings, as far as India is concerned, still remains fairly constructive. You have 13 to 15% earnings projections for next 2 years. And the valuation is broadly in fair zone. And while I would say that valuation still is in fair zone, that is where the structural part of the market comes in, whereby if one looks at where basically the business cycle is in India, where the credit cycle is, where the earnings cycle is, from a 3-year perspective, clearly, in our belief, you are in a business cycle, you are in a credit growth cycle, you are in an earnings cycle, and that is predominantly driven by the way balance sheets are likely to reflate, and that reflation has already started, which is visible in the investment part of the market. And as those balance sheets keep reflating, which have been completely cleaned, if you look at bank balance sheets, if you look at the corporate balance sheets, those are clean balance sheets today. As those balance sheets reflect through next 2-3 years, you would experience basically business cycle, you experience job creation, you would experience basically the earnings of
correct.
And when you have that kind of basically equation, whereby you are in a effectively in a business cycle.
Shridatta, you're clearly indicating that India is in for a very good period. So, that's good to know. Shridatta, just coming back to you in just a bit, the markets have gone back to that 19,500 odd. And as we have seen in the last few days, quickly we have given 50 points from the high point of the day. So intraday chart of the markets, will tell you that the Nifty should come up for you yet again, 19,500 in the first few minutes. And we are dropped 50 points from the top. And just one more stock. Saturn Credit Care, there was 2% equity that changed hands. Ticker team will alert you on that one. The stock is up 9.5% odd. So we'll try to find out who exactly were the parties to this. But that's up close to around 8.5% as we speak. Well, Shridatta, as you're saying, various reasons why India will do well from here. And structurally, things are looking up. You all have a new offering, right? The NFO. Tell us more about that. That's a multi-cap, I believe, NFO. What is the target out here? I mean, where will you be deploying this money?
So Canara Robeco Multi-Cap Fund is the new offering. The offering clearly is a diversified and balanced product whereby the deployment would be as a category, you have 25% minimum each in large cap, mid cap, small cap, and rest 25% is discretionary based on the fund manager's view in terms of where the view is from a contextual perspective. As far as we are concerned, we intend to run this product more broad-based, which means we intend to run this product for next 3-5 years from a more mid-cap, small-cap orientation perspective. So we'll run this product broadly 60-40 as a basket within the 100 rupees allocation.
I was reading one headline, Shridatta. 20 fund houses have raised their cash holding in the first 6 months of the calendar year. And 11 of them have a cash holding in excess of 5%. Some fund houses are worried that even if you raise money right now, how do you deploy it at these levels? I know you're comfortable with India's earnings growth trajectory, and the valuations, according to you, as you rightly explained, appears to be fairly reasonable. But could you talk about, the pockets where you think you would be deploying the money raised via this NFO?
Sure. So, Reema, as you rightly pointed out, of course, market has moved up 10-12%, and so to that extent, there is a little bit of upfronting of returns that has happened in certain pockets. But as far as the pockets where we see basically structural opportunities from next 2-3 years and where the money can still be deployed, if one starts extending the view from 3 months, 6 months to a year or more than a year, those areas would be more broadly domestic cyclicals to start with. So your basically financials, consumer discretionary, the entire manufacturing supply chain, the domestic pharma space, the telecom space. These are the spaces where we think that the opportunities are still there. And the other space which gradually is actually turning, at least from valuation perspective to start with, more constructive is IT, while the earnings are likely to experience pain for next few quarters. But as long as US doesn't go into a deep recession, at some point in time, this sector again will become interesting. So those are the spaces which we are looking at in terms of deployment of the money.
Okay, by the way, the market is sort of steady. It's not building on to any of its gains. But the one big trend that we're noticing this morning is that IT stocks are seeing a lot of buying, not just the frontliners like, Infosys, TCS, etc., but in the broader markets, Emphasis, Mastech, eClerx, all of these stocks, Happiest Mind, First Source, are all trending in the green. So that's the million-dollar question. Has the buying in IT begun? Look at Emphasis, up 2.5% right now. But Shridatta, the space that has got the maximum amount of traction this year is autos. If you look at it, not just Tata Motors, names like Bajaj Auto, all up 40-60% this year. Is there more to go, or is this run done?
So auto, clearly, it's again in a positive replacement cycle, most of those companies. And of course, we can't talk about stocks, but the specific stock you spoke about, it is more to do with balance sheet rather than P&L in that particular case. But generally, your volume growth for at least financial year 24 in auto should remain still resilient. Of course, you would have to actually probably, if you look at last 1 year, and as you rightly alluded, you had auto OEMs clearly outperforming the ancillaries. I think the opportunities will again, as time passes, the opportunities will move again back to auto ancillaries rather than auto OEM. In auto OEM, a lot of the next 2 years' earnings seems to be kind of getting captured gradually.
Shridatta, what about the real estate space? I mean, have you all been playing that theme? And there are various ways to play it, right? It's not only the listed real estate stocks. You could play the housing finance companies. You could play maybe a couple of ancillaries out there. What's your exposure?
Generally, we are not a big fan of real estate. And I think the reasons are fairly well known in terms of the challenges of generating free cash flows by these businesses. But we have been generally, the real estate cycle is on the right side of the curve, and we're actually playing through housing finance companies, one, and second, generally building material companies, and third, through cement companies. So all those three basically supply chains, value chains, we are playing as a proxy to real estate through our portfolios.
You said you're bullish on IT, right, over the long term, and you think right now the correction that we've seen over the last few weeks is perhaps an attractive opportunity. What's the thesis that you have over the next 12 to 18 months? How do you see it play out?
We are not bullish on IT, but we think that the earnings downgrade cycle probably is coming towards an end at somewhere probably closer to end. And as far as at least the large cap IT is concerned, clearly the valuations have come to a zone where if one starts taking 2-3 year view, and one knows that this sector over a long period of time has delivered at least minimum 10-12% earnings growth. Those valuation points, as far as large cap IT is concerned, have started turning far more constructive. Having said that, still you have challenges. One can't ignore the fact that basically the end markets, which is US and Europe for most of these companies, are still going through moderation of growth, and that will play out time to time, and that's where the earnings, at least the upgrade cycle, is still some time away for this sector, clearly.
Okay, the upgrade cycle is some time away. Got that. Shridatta, thank you for joining in, and hope we see you more often on the channel. Thanks for being with us and giving us your thoughts. Well.